Alphabet Inc. Ticker symbol GOOG is currently trading at $154.65 a share. It's been hammered. It was down 5% yesterday, and year to date it is down about 18%. They have just released their Gemini 2.5 Pro, which is an advanced AI model designed to enhance performance in complex tasks. It leads benchmarks, superior reasoning, coding, everything like that. And I have been using it myself. And it looks pretty good, but I haven't got the answer to this question just yet. So what we're going to be doing today is looking at my automated stock valuation spreadsheet, seeing if Google is a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So let's just put in the ticker GOOG, and this will load up all the latest company financial data. Just while that is loading, if you're interested in my Patreon, please check it out. It's the $4 tier for the sheet. I'll just close that down as well. So as said before, $156 a share, $1.9 trillion in market cap, PE ratio of 20.2, which is a lot lower than the market average, although it's dropping slightly, 27.8. Earnings per share, $7.72. I don't know if you heard that, but my cat is a bit hyper at the minute. Cute cat, Smokey. A beta of 1.03, meaning it is just as volatile as the market, and analysts do say it is a buy. Target price of $217. They do pay a dividend, 0.51%, which means you get 80 cents per share. Very, very safe dividend, 4% of the net income, 6% of the free cash flow, and buy before the 10th of June if you want to get paid. So let's have a look at revenues. This is trailing 12 months, 348 billion. Relatively flat from the last year, but as you can see, steadily increasing. Net income, are they able to generate more profit? Yes, 112.12 billion. A very, very profitable company. They've managed to generate more profit off these revenues. Free cash flow, 72 billion, or nearly 73. And if we look at operating cash flow versus capex, you can see operating cash flow is jumping up massively. Capex is increasing. So if they were cutting the capex, obviously then the free cash flow would be even higher. They've got a lot of cash, Google. Shares outstanding. There's a split in here. We can see they've had a very aggressive buyback program, and at the current prices, it seems to be a good idea. Let's have a look at the discounted free cash flow model. This is where valuing stocks at the future free cash flows and discounting them to today's value. Let me just put in the averages here, and it is giving us a price of $176 a share. Now let's see if we agree with those numbers. We're expecting quite 103.90, 430 in terms of the coming years, and that is pretty much where analysts have it as well, so that's good to see. In terms of growth, about the same as the S&P 500, so I'm happy with those numbers. Net income margins, see, I think this is maybe a bit high. We'll take an average of these few years. It's going to bring it down ever so slightly. We'll say 27%. Sorry, let me just get the exact number there just to be a bit more safe. 27.74 brings us down to 160. And in terms of the net income to free cash flow, I'm pretty happy with that as well. You can see the averages. If we look at the more recent years, about 78%, I think that is fair. So yeah, it does put it at about 160. So fairly valued, maybe a bit undervalued on the discounted free cash flow model. Dividend discount model, we can't use that actually because we haven't had enough years of dividend growth, but because they've added it in 2014, we can use this in a few years. Ben Graham formula for intrinsic value. Looks at the earnings per share, PE of a non-growth company, AAA bond yield, corporate bond yield, and then gives us a price. Still 5.32%, and I think we saw it was about 14% for the growth of Google, 14.2. So expecting slightly less than the S&P 500, but it does put it at $143 a share. So not a buy on that. If they're able to grow it about, well, anywhere over 17%, it would be a buy, but yeah, currently Ben Graham does not think it's a buy. The discounted free cash flow model says it's a buy. Ben Graham doesn't, and we can't use the dividend discount model. So finally, we will use the comparable company model. This is the way of valuing stocks, looking at their competitors, and we'll be looking at the revenue growth rates, EBITDA, net income, profit margin, price to sales, price to book, Peter Lynch's price to earning growth, and then the specific metrics are EV to revenue, EV to EBITDA, PE, and forward PE. So what we'll do is we will look at, I'll just do this on the other screen. We'll do two here. So this is top S&P 500 constituents by weight. Google is the 7th. Okay, they've gone down quite a bit. Fine. So we'll look at the their most related tech companies. We'll do MSFT, which is Microsoft. We will do Amazon, and we will do Meta as well. If you're interested in this sheet, please check out my Patreon's $4 tier, and if you haven't liked and subscribed, please do as well. It really helps me out. Yeah, give me your thoughts down below if you think Google is a buy or a sell. So enterprise value, Google middle of the pack, Meta 1.4 trillion, Amazon 2, Microsoft 2.7. Revenues, Google is the second highest revenues. Revenue growth rate, second lowest. EBITDA, second highest. Most profitable though, 100 billion, middle of the road. Well, way more than Amazon, but obviously Amazon, a lot of the e-commerce side will bring this down. If they were just AWS, it'd be a lot higher. But you can see about 29% compared to that 36 and 38%. Price to sales, market average is around about 2.8. All of these are higher than that, but Google towards the bottom. Price to book, market average is around about 4.8 again. Google is the lowest. Now, PEG, which is Peter Lynch's price to earnings growth, ideally you want this under 1. None of these are under 1, but Google is the lowest. EV to revenue, second lowest. EV to EBITDA lowest. Forward PE lowest, and forward PE lowest, which gives us a price of $198 a share looking at these averages. So it is a buy comparing to sort of 3 of their closest competitors. Now, if we were to switch out, let's just say we'll switch out Amazon, replace them with Apple, just to see what it is. So it's $198 a share currently. Let's see if this what this compares them to, because if we look here, yeah, see, because of Amazon's things, Apple, compared to Apple, it brings the price up to $217 a share, so even more so of a buy. If we were to say we've got, so ahead of Google is Berkshire, Meta, Amazon, Nvidia. Okay, so let's compare. Let's take up Meta now just to compare, and we'll do Nvidia. I could add more stocks into this actually. I think it'd be quite cool. Let's see. Yeah, see, now if we compare Nvidia's multiple is 260. So Google does look lower than its competitors by quite a bit. Does look undervalued at its current price. Now, go over the stock over the last year. We said it's relatively flat. Year to date is down 70%. Even with this, over the last 5 years, it is up 184%, which actually beats Amazon, which is about 100. Now, one thing you do have to take into consideration here currently, beat the market 123, but because of where we are now, if we go to, let me just close this down, be careful when looking at the charts, as if we go max, about 5 years ago was we're coming towards the, well, we're just after the bottom of the pandemic, but obviously it's regaining a little bit since then. So yeah, so there will be a bit more swings on those, but it has beat the market over those times. Right guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Check my Patreon, and I'll catch you guys next time.